This is Macro Horizons, episode 356, HNY, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of January 12th. And as we wrap up the first full week of trading in 2026, the key unanswered question remains: how far into January does one still say Happy New Year? It's clearly too late now. That salutation ship has set sail. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the Treasury market had an array of influences to drive trading direction. The most relevant on the fundamental side came in the form of Friday's non-farm payrolls print. Headline payrolls growth in December slowed to 50,000 jobs from November's revised level of 56,000 jobs. This was slightly below the consensus expectation of 70,000 jobs, and we saw two-month net revisions down 75,000 jobs. For context, the two-month net revisions have come in negative in 9 of the last 10 months. Moreover, private payrolls disappointed at just 37,000 jobs. This was notably consistent with what we saw from ADP and reinforced the notion that the labor market stabilized into the end of the year. Now, we're certainly cognizant that many investors anticipate that the jobs market will come back strong in 2026, although we find ourselves somewhat more skeptical that that's an obvious outcome given all of the macroeconomic crosscurrents at the moment. Taking a look at some of the details within the employment report, we see that the labor force participation rate slipped to a 3-month low at 62.4%. This was in line with expectations. We also saw that the month-over-month gain in average hourly earnings matched the consensus at plus 0.3%. This nonetheless brought the year-over-year pace up to 3.8 versus the 3.6 prior. Now, it's interesting to put wages in the context of what we learned from the productivity report, specifically that unit labor costs were negative in Q3 as well as in Q2. This is the first time we've seen 2 consecutive negative unit labor cost prints since 2019. So there has clearly been some cooling on the wage front, and that's very consistent with a labor market that we'll characterize as stalling out, if not deteriorating in outright terms. In terms of the unemployment rate, it came in better than expected, or lower in this case, and on an unrounded basis, the unemployment rate was 4.375. That's versus November's revised figure of 4.536. Now, it's worth highlighting that there were benchmark revisions to the household survey which changed the seasonal factors and brought November's number lower as well. So on net, we'll argue that there's still too much noise in the unemployment rate to definitively say that the worst has passed for the labor market. Geopolitical tensions were also back in the market following Trump's decision related to Venezuela, although it is notable that there has only been limited price action associated with the developments. The administration also weighed in, once again, on housing affordability, calling on Fannie and Freddie to buy $200 billion worth of MBS. Technically, Fannie and Freddie are allowed to own up to $225 billion in mortgage-backed securities each. So that creates a combined capacity of $450 billion. At present, combined, they own about $247 billion. So that means that within the current cap structure, they could buy up to effectively another $200 billion or $100 billion each. Now, in the event that this comes to fruition, the implementation of these purchases will be the key. If they simply take their own supply, for example, which is our operating assumption, then it will be scaled in over the course of, let's call it 10 or 12 months, and probably translate to a quarter point lower for mortgage rates. So on net, the move is unlikely to be a massive win for potential homebuyers, although it is notable that the administration continues to attempt to address affordability.
Well, it's a new year. We have a payrolls report, almost a Supreme Court decision about the legality of tariffs, a removal of a Venezuelan president, and I think it's safe to say that 2026 is off to a hot start.
A hot start, to be sure. However, it's very, very remarkable that the 10-year yield has managed to retain an extremely narrow range, and frankly, volatility in the sector continues to decline even despite all of the developments that have occurred thus far in the new year. All else being equal, we would have assumed that the combination of a good enough employment report, as well as the risks associated with the Supreme Court ruling, would have netted to underperformance of duration, as opposed to moving into the middle of January, pretty much where we've been for the last 6 weeks. Now, obviously, there are some meaningful event risks still on the horizon. The first that comes to mind is a Supreme Court decision. The second is who the president ultimately decides will replace Powell. Clearly, the speculation last year that Trump would make his decision early hasn't come to fruition. In fact, given that the current chatter is that the announcement will come sometime after the 19th of January, it's frankly somewhat later in the process than is typically the case. In practical terms, that simply means that the Fed won't have to choose between the message from Powell and Powell's eventual replacement.
But regardless of who ultimately replaces Powell, it's still clear, even after the aggregate of the data we've received over the past month or so, that the Fed's easing bias is intact. Now, this doesn't mean that we're going to see a cut at the end of this month. In fact, now that we have payrolls and have seen the decline in the unemployment rate, it's extremely unlikely that we're going to see a fourth consecutive rate cut, and the next live meeting in terms of a 25 basis point policy move is going to come in March. The fact remains that the messaging from incoming chair candidates, but also current members of the FOMC, still favors ongoing easing, and even though inflation is not at 2%, and even the SEP acknowledges will not be at 2% for at least the next several years, the risks to the labor market are still viewed as more pronounced than the upside risks to consumer price growth. And so, to your point about the trading range in tens, Ian, what this has translated to is a treasury market in a very low volatility regime, an investor base that is eager to do nothing in terms of a reallocation of risk, and a general market backdrop that is firmly in wait-and-see mode. And that wait-and-see mode is just as much centered around geopolitical events as it is economic ones. Obviously, the events in Venezuela to start the year have material geopolitical implications, both directly, given what's going to happen with Venezuelan oil, and indirectly, given what the U.S.'s decision implies about potential further action over the balance of the Trump administration. But for the time being, tens between 4 and 4.2% seems to be just about right.
And frankly, it's difficult to envision anything over the course of the next few weeks really changing the macro narrative to any significant degree. We do have the CPI figures for December that will be issued next week. However, given the shutdown-related noise in the October and November series, even a higher than expected print will be dismissed by the market as simply a residual based on the shutdown. Now, clearly, as we look forward to the incoming data for Q1 and Q2, that will be a different story. We will have a better sense of the overall trajectory of inflation. One thing is clear, however, the fact that we didn't see 100% tariff pass-through over the course of the summer of 2025 means that the fallout from the trade war will likely be spread out over several quarters, which clearly dissipates the impact and makes it less of a consideration for monetary policymakers in the near term. Now, the FOMC has made it very clear that the employment mandate is in the driver's seat at the moment, and even as the December payrolls report revealed private NFP of just 37,000, the prevailing interpretation is that the labor market remains stable, no hiring, no firing, but we could be at an inflection point that ultimately resolves into more jobs creation in Q1 and Q2. To say that this is the market's major wild card at the moment would be an understatement.
And coinciding with that timing is also going to be what's also widely expected to be a tailwind from the fiscal side as well, and the boost from what's expected to be heavy tax refunds, and from a consumer point of view, more distance put in between current spending habits and the volatility and uncertainty around Liberation Day. Obviously, the overall state of the world has had a heavy impact on consumer sentiment, but the fact that there's some signs of affirming in the labor market, you're going to have some of the Trump administration's pro-business impulses begin to trickle through to the real economy, all in an environment when the Fed is still in removing restriction mode and not even close to considering a more restrictive monetary policy bias, all leaves our expectation that the yield range in the near term will break to the upside intact. To say nothing of what we're continuing to see in risk assets and an S&P 500 that's had a strong start to 2026, we're coming into the new year with a sense of underlying optimism that, yes, the labor market is cooling, but maybe is cooling at a slower rate than it was. We have a Fed that is in no hurry to tamp down economic growth, and a White House that, as with any White House, would like a much stronger economy. All of this continues to suggest that the medium to longer term path for the yield curve is steeper. After all, if the Fed's going to cut, two-year yields should benefit, and if growth is going to look okay, that means the long end should probably underperform.
And as is often the case at the beginning of the year, the combination of the same optimism, green shoots, outperformance of equities, as well as the seasonality of the inflation complex imply at least several weeks of an underlying bearishness for the Treasury market. Now, when we think about the event risks on the horizon, the idea that a Supreme Court ruling against Trump's tariffs should translate into significant selling in the Treasury market is difficult to square with the messaging that we received from the Treasury Department. Specifically, Bessent has made it clear that any shortcoming on the funding side will translate into higher bill issuance, as opposed to translating into higher coupon auction sizes for 10s, 20s, and 30s. Moreover, the administration has already acknowledged that they have a Plan B for tariffs that would take effect immediately or shortly after any ruling against Trump's Liberation Day tariffs. Therefore, while there are still uncertainties regarding, for example, what happens to all the tariff revenue that was collected during the last several months, at the end of the day, from the perspective of the budget deficit going forward, our read is that the Supreme Court ruling is simply a bump in the proverbial road.
And the good news from Bessent's perspective about funding any shortfall in terms of the deficit with the front end of the curve is that we already have a central bank that is buying precisely the sectors that the Treasury Department may continue to increase. Obviously, our MPs thus far have been focused in the shorter parts of the bill curve, but remember, within the language of the November refunding statement, the Fed laid the groundwork for potentially longer purchases out to and including 3-year notes. And so, if there are distortions in the bill market caused by SOMA's buying, there is certainly scope for a shift in the program in the name of reserve management to purchase longer securities out into the front end of the coupon curve. This at a time when we're already starting to discuss which Treasury auctions are going to be the first to increase later this year. We're expecting that's going to take place at the November refunding cycle, and 2s and 3s, maybe 5s, are easily the first ones that come to mind. While it's not MMT, it sort of looks like it, and as we continue to contemplate how the shift in Washington will affect the global economy and the Treasury market, a Bessent Treasury that's issuing bills and notes that whoever Fed is going to ultimately be buying should also have underlying inflationary implications that will put a floor under just how far yields will be able to fall. Now, this is a different story than in the long end of the curve, where we've heard from Trump and Bessent that they want longer dated yields lower, now with the added benefit of $200 billion in mortgage buying from Fannie and Freddie to boost the housing market. And taken together, all these factors point to a collective Washington, both from a Fed, Treasury, and White House point of view, that want the economy continuing to run hot.
Run hot. But just as long as there's no inflation. Hey, could happen.
This time is different.
Always is. In the week ahead, the primary focus of the Treasury market will be inflation. CPI is released on Tuesday. Here, the market is looking for a 0.3% increase in both headline and core CPI. We'll argue that the peak relevance of inflation has passed. In light of the employment figures, the Fed now has plenty of cover to not cut rates when they decide on January 28th. In fact, that's our operating assumption. We think that January will be a pause on the path to normalization, and even if we do get a higher than expected core CPI print, the data distortions created by the shutdown have created plenty of open questions about the October and November CPI numbers. The week ahead also contains PPI and retail sales, as well as an array of commentary from Fed speakers. We anticipate that the messaging coming from the Fed will be one of caution, specifically caution against assuming that they will cut again in January. The Fed has convincingly signaled that monetary policy is in the mode of data dependence, and December labor market conditions suggest that the Fed has time to wait before the next rate cut. On the supply side, given the timing of January 15th, i.e. falling on a Thursday, the auction schedule has been moved forward. On Monday morning, we'll see 58 billion 3 years, and then on Monday afternoon, 39 billion 10 years will be auctioned. Tuesday sees 22 billion 30 years auctioned in the afternoon. Overall, we expect that the auctions will be reasonably well received, although a supply concession seems warranted, especially given the recent price action. As January unfolds, Trump's decision on the next FOMC chair will remain top of mind. Whether it's Hassett, Warsh, or Waller remains an open question, and while we don't anticipate learning the president's final decision by the end of the week ahead, it will most likely be in the market by the end of January. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And while the work week ahead is technically only 5 days long, the upcoming holiday weekend is sure to make it feel like 10. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/macrohorizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.